Hey everyone, and welcome to This Explainer. Today we're tackling one of the most fundamentally misunderstood concepts in all of business. We are going to demystify your bottom line using some incredible insights from Jack Perkins and the team at CRI CFO Hub. We're talking the real anatomy of profit, actionable pricing strategies, and exactly how to rein in those operational costs.
So let's kick things off with a number that should give us all a bit of hope, but also a real sense of urgency. 65%. According to the latest stats highlighted by CRI CFO Hub, 65% of small businesses are currently profitable. Now that's actually a pretty huge improvement from previous years. It's a great optimistic baseline, but it instantly forces you to ask yourself a tough question. Is your company sitting comfortably in that 65%, or are you kind of stuck in the remaining 35% that's just struggling to cross the finish line? Because the difference between thriving and merely surviving, it usually comes down to understanding the actual mechanics of your profitability. Okay, let's get our terms straight right out of the gate. First up, we have revenue. That's simply the total money flowing into your business, your top-line sales, right? Then we have profitability, which is the money you actually get to keep after covering all your expenses. So why is this distinction so absolutely crucial? Well, because a lot of business owners fall into the dangerous trap of focusing strictly on sales volume. You can have a company pulling in millions in revenue, but if you've got sky-high costs, poor pricing, or terrible operational inefficiencies, you might literally have zero profitability. On the flip side, a business with much more modest revenue can achieve incredible profitability just through smart cost controls.
To really ground these abstract concepts, I love this analogy from the New Money blog. It's called the cake shop. Imagine a bustling, popular bakery that just hit an amazing milestone, $1 million in revenue. $1 million worth of cakes sold. Sounds like they're rich, right? But as we trace that $1 million down to the final cut, we're going to see exactly how business profits actually work in the real world. Let's actually walk sequentially down the income statement here. We start at the top line, our $1 million in total cakes sold. But obviously, you can't make a cake out of thin air. We have to subtract our cost of goods sold, or COGS. This is the flour, the sugar, the butter, the direct ingredients. In our example here, that costs $300,000. Subtracting that gives us our very first milestone, gross profit. We're now at $700,000. This just shows what we earn strictly from our core business activity. But wait, we still have to pay for the building and keep the lights on. So next, we subtract operating expenses. That's your rent, your various utility bills, and your salaries. Boom! That's another $300,000 gone. This brings us to our second milestone, operating profit, which sits at $400,000. This is what the business earns before the bank and the government decide to take their share. Finally, we subtract our non-operating expenses. Say we pay $100,000 in interest on our bank loans. That leaves a profit before tax of $300,000. Then, the government steps in for its slice, with a 25% tax rate taking out another $75,000. And we finally arrive at the true bottom line, net profit. From $1 million in revenue, the cake shop actually takes home $225,000. That is a net profit margin of 22.5%. Seeing it broken down like this really changes how you view that $1 million sales figure, doesn't it?
Right, so now that we've mapped out the anatomy of profit, let's transition into action with Strategy 1, optimizing pricing and revenue. I want you to really absorb this fact. How you price your services impacts your profitability more than literally any other single factor. So many businesses severely undercharge for their products, and they're just quietly eroding their profit margins without even realizing it. When you're doing your regular pricing analysis to make sure your rates actually reflect current market conditions and your real costs, you have a few options. There's cost-plus pricing, where you just mark up your expenses. There's competitive pricing, where you basically just match the guy down the street. But the absolute champion here, the one that CRI CFO Hub explicitly highlights as yielding the highest profitability, is value-based pricing. Why? Because instead of looking inward at your own costs, value-based pricing focuses outward on the immense benefits you're delivering to your customer. Like if your software saves a client $50,000 a year, pricing it at $5,000 based on that immense value makes way more sense than pricing it at $500 just because it's cheap for you to host.
But pricing isn't the only way to optimize your top line. You also need to look at how you generate those sales. Generating revenue through your existing customers costs significantly less than acquiring brand new ones. Think about it, you've already spent the marketing dollars. You can boost your average order value so efficiently just by offering upsells or cross-selling strategies. Product bundling is great too, and encourages customers to buy multiple related items all at once. And if you can implement subscription models, that is honestly the holy grail. Subscriptions create predictable, recurring revenue streams that dramatically improve your cash flow and massively boost your customers' lifetime value.
Okay, let's pivot to the other side of the equation now. Strategy 2, mastering costs and operations. You absolutely have to control what flows out. But here's the thing. This requires systematic analysis, not just slashing budgets and burning your quality. If you cut corners on the quality of your cake ingredients, yeah, you might save a few bucks today, but your revenue is going to plummet tomorrow when your customers stop coming back. To strategically prioritize your efforts, you have to understand the two main types of costs. Fixed costs are exactly what they sound like. They remain constant regardless of your sales volume. Your rent, your baseline insurance. Whether you sell 0 cakes or 1,000,000 cakes, your landlord still wants the exact same check. Variable costs, on the other hand, fluctuate directly with your business activity. The more cakes you bake, the more flour you buy. Understanding this distinction is absolutely vital because it tells you exactly where you have immediate leverage to improve your margins as your volume shifts.
So how do we actually put this into practice? You need actionable operational improvements. First up, conduct regular expense audits. Honestly, you'd be amazed at what you find, like how many software subscriptions are you paying for right now that nobody has touched in a year? Second, renegotiate your vendor contracts or consolidate your suppliers to get better volume rates. Third, look at technology to automate repetitive administrative tasks. That frees up your team for much higher value work. And finally, if you hold physical products, optimize your inventory. Look into just-in-time inventory systems and demand forecasting. Excess inventory just ties up your cash and costs you money to store. But a quick word of warning from the experts here. As you do all this, aggressively avoid cutting any costs that directly support your revenue generation. And that brings us to our third and final pillar. Strategy 3, tracking for long-term success. Look, we can implement all the pricing strategies and cost controls in the world, but without accurate financial reporting, you are essentially flying the plane blindfolded. Proper financial management is the true bedrock foundation of profitable operations. To take off that blindfold, you need a system. Establish clear key performance indicators, or KPIs, and track them consistently. You need to be reviewing your financial statements, your profit and loss analysis, your cash flow projections every single month. And cash flow management here is absolutely critical. You need to accelerate your receivables collection, get paid faster, negotiate favorable terms with your own suppliers, and maintain some cash reserves. Why? Because you can actually be highly profitable on paper, but if all your cash is tied up in unpaid invoices, you can still trigger a massive cash flow crisis that could completely derail your whole business. Finally, use professional advisory services to benchmark your metrics against industry standards, just so you know exactly where your profitability targets should actually be.
Now, I know this sounds like a lot to manage, especially if you're busy running the day-to-day operations of your company. But as this excellent quote from CRI CFO Hub reminds us, improving business profitability requires expert financial guidance and systematic implementation of proven strategies. The really good news here, you absolutely do not have to tackle this alone. This is exactly where fractional CFO services come into play. Firms like CRI CFO Hub, founded by Jack Perkins, provide smaller businesses with access to senior-level financial expertise and strategic planning. You get the heavy-hitting financial guidance to maximize your profitability, but without having to pay a full-time executive price tag. It's honestly a brilliant way to scale your financial strategy. So as we wrap up this explainer, I want to leave you with one final, provocative thought inspired by Jack Perkins' insights. I want you to look really closely at your own business model and ask yourself honestly, are you just generating revenue or are you building lasting profitability? Remember the cake shop. It's not about how massive that million-dollar top line is. It's about how carefully you protect, optimize, and manage every single slice as it travels all the way down to the bottom line. Don't let profitability challenges limit your potential. Dig into your numbers, assess your pricing, and aggressively optimize your true bottom line. Thank you so much for joining me to explore this vital topic. Keep learning, keep optimizing, and I'll see you next time.